Hi, and welcome to another Coffee with Waymark. Today's episode, we're going to talk about rate cuts. In the middle of September 2024, we are looking at potentially a rate cut by the Fed. They pretty much, for all intents and purposes, telegraphed it at the Jackson Hole conference in Wyoming this past month, where they pretty much said that it seems like it's about time that we're going to cut rates. So with that said, that is what is going on. So two things that I want to talk about today. One, why does the Fed even do this? Why does the Fed cut rates? And then number two, how does it typically cause the market to react? So let's start with the first question. Why does the market cut, or why does the Fed cut rates? Well, the Fed cuts rates because at the end of the day, I don't want to say dirty secret, that's not the right thing to say, but just what makes any economy run is the idea of borrowing. So whether it's your mortgage, your car loan, your credit card, people consume goods, and a lot of times they use credit in order to consume the goods. So if interest rates are through the roof, that may cause people to pull back on making those types of decisions. Perfect example, when interest rates in the United States just a couple of years ago for mortgages were down to about 3%, even less in some cases, people were buying houses. Lots of activity, lots of economic activity that was going on, and there's a ripple effect. So for instance, you buy a house. Well, what are some of the things that you do? You might hire a contractor that employs someone that wasn't employed before. You go to Home Depot, you go to Lowe's, you go to home improvement places, you go to tile stores, you start consuming more because of that one purchase, and that one purchase was encouraged by having a low interest rate. And the flip side is also true. Right now, interest rates for mortgages are somewhere between 6 and 7.5%, depending on the day. And what's happened? People have pretty much put the brakes on selling their house because they know they're going to have to buy a new house and potentially increase their interest rate. So interest rates do matter, and they do impact customer activity. Let's switch gears to what happens with the market. Well, one of the things that I've mentioned in a number of these videos is that the consumer drives the economy. So what I mean by that is if you look at the statistics, anywhere between 66 to 70% of economic activity is driven by the consumer. How much people consume, what they buy or spend their money on. If consumer has kind of put the brakes on spending, guess what happens to the economy? Things start going south. And the flip side is true. If they're encouraged to spend money and spend money on credit sometimes because interest rates are so low, they'll start spending money. If they start spending money, economy does well. If they start holding back on spending, economy goes down. And so that's pretty much what's going on here, is that this is a very critical lever that the Jerome Powell can exploit to either throttle up economic activity or throttle down economic activity. We can get into the dual mandate that the Fed has, which is on one hand to keep inflation in check, but on the other hand, keep full employment. And those are competing initiatives. So what I mean by that is when unemployment is very low, that's typically inflationary. So you have low unemployment, but high inflation, and the flip side is true. If unemployment starts ticking up, inflation starts going down. And what the Fed is constantly trying to do is put that in balance. And unfortunately, it's a very difficult balance to try to strike. So what is that? So let's go to question number two. So question number two is what happens with the market when the Fed drops rates like they will anticipate, or the market is anticipating that they'll do mid-September 2024. So let's take a look. And what I'm showing here on the screen is historical rates of return of the S&P 500 1 month, 3 months, 6 months, and 12 months after a rate cut actually happens. And long story short, this is pretty much the key numbers that I want you to hone in on, is that 12 months from the time that the Fed drops rates, 2/3 of the time, at least historically speaking, the market has actually reacted in a positive way. And it's reacted in a positive way on average 5.5%. But if you take all these different numbers, strike out the outliers, you get more like a 10% rate of return. So of course, I'll say this like I say all the time, there's no promises here. All this is saying is that historically speaking, the market typically responds positively, at least, again, I have to choose my words carefully. Historically, the majority of the time, the market has performed in a positive way after a rate cut 12 months after the rate cut has actually happened. But long story short, history is never something that you can rely on for future returns. So that's all I have for today's Coffee with Waymark. I hope this was helpful. And remember, be well and do good. Take care.